All right, let's go ahead and get started. It is Monday, November 23rd at about 12:30 in the afternoon. Basically, what we're going to do today is we're going to talk about our multiples analysis and assignment. I put onto Elms in the files folder under lecture notes an updated lecture note 6, which we're going to cover in just a minute. Also in the files folder, there's an Excel file that you're going to need. Basically, it's called under the folder called multiples, which is the multiples assignment template. So those are the two files that you're going to need in order to do the in-class follow along and the assignment that is coming up for homework. So while we're doing that, I just wanted to mention a few things. Share my screen here. So a couple things is if you go to the file section under multiples, that's the Excel file. And again, under lecture notes 6. I also changed under the assignments down here. So just a little bit of end of class logistics. There are two, they're listed under extra credit, but basically there are two individual homework assignments replacements available to you. One for everybody and the other for the 4 teams that did the presentation to the Aetna CFO. The way the assignment replacements will work is that basically if you do the minimum 500 word paper for the assignment replacement by December 7th, the TAs will go through your individual assignments, which would be either your Bloomberg certification or the homework assignments. They will replace the lowest one with a full grade as if you did it. Okay, so you don't have to tell them which assignment, they will figure that part out. You just need to do the homework assignment replacement by December 7th, end of day. For the teams that did the Aetna CFO presentation, you get a second individual homework assignment replacement, which again will work in a similar process. The TAs will replace, again, in your case, the lowest 2 grades of the individual assignments throughout the semester. The individual assignment replacements cannot be used to replace a team grade or an exam. Those are separate. Also, starting Monday, 1 week from today, your first extra credit assignment will be available. So there will be 3 extra credit assignments coming up. One will be Monday, week from today. You'll have an assignment due. That's extra credit. You don't have to do it. If you want to do it, you can. It's worth 2 points. There'll be one the following Wednesday, a week from Wednesday, and then 2 Wednesdays from them, there'll be a 3rd extra credit assignment. So those are the 3 extra credits that are becoming available. Those extra credits just add points to your semester grade. If you remember in the first day of class, I said that grading in the semester works on total of points accumulated. So Elms will mislead you about your semester grade because Elms is not set up to handle the way we do grading in this class. So what I mean by that is Elms shows you a percentage of total points. And right now there's 100 points available in the semester. Very shortly, there's going to be about 105 points available this semester when I add in the extra credit assignments. And so Elms will show you a grade as a percentage of 105. So to get an A and minus in this class or an A in this class, to get an A, you need 93 total points. So Elms will show 93 out of 105 as a percentage, which is actually not the way your grade will be calculated. Your grade will be 93 total points is an A. 90 total points is an A minus out of 105 total points. So it's not percentage of total, it's accumulating points across all assignments to get to, again, 87 points is a B plus. So 87 out of 105 total points will be a B plus this semester, okay? And so the points for the extra credit really are to make up for any challenges you had for Bloomberg Trading Challenge, any challenges on an exam, and or other homework assignments you may not have done, but that is your opportunity to improve your grade as well. So those extra credits are available, and those will be the only extra credits available this semester. One final thing, I don't round. So if your grade turns out to be an 89.5 for the semester, you get a B plus. You don't get an A minus. So the only way to improve your grade is to do the extra credit. Okay? So again, one of the extra credit assignments is due 1 week from today. So I want to get through class as quickly as possible. So those of you that choose to work on it have a little bit of time at the end of class to do that. Okay. The other thing that's going to happen next week is peer reviews. So I am going to post the ability to give peer reviews on any of the 4 group projects. What that practically means is that everybody gets a team grade on your group projects, unless the peer reviews set from one, or you need more than one person, but more than one person basically say that you didn't fairly participate in a group project. If they say that, then your grade will be lower. Okay. Otherwise, the peer reviews are optional. And if everybody participated fairly, you don't need to fill out any peer reviews. The other change that I have made is that the 4th group project is now going to be due in class presented on multiples on Monday, December 7th. Okay. So basically 2 weeks from today, Monday, December 7th, you'll be making your final 4th 10-minute presentation on multiples, which is why we need to get the multiples as quickly as possible today in class. Right. And Monday, December 14th is the last day of class, which will be the optional final exam. So on or about December 8th or 9th, the TAs will tell you whether or not you opt out of the final exam. If you meet the opt-out criteria, then you'll just get the points for the final exam. If you don't meet the opt-out criteria, then you'll have to take the final exam in class during class time on Monday, the 14th. The final exam will be a multiple choice open book exam. It will be auto scored by ELMS. And again, you'll get the exam grade that day. Okay. And that'll be the final grading and for the class. So basically, if you opt out of the final exam, your final class will be the Wednesday before, or the 9th of December. Okay. Those are just some end of semester items to wrap up. Questions about any of that?
Yeah, I'm sorry, Professor. I missed the first part of that. When did you say the TAs were going to let us know about opting out?
For the final exam, on or about the 8th or 9th, once all the grades
Okay.
are filled out. And then you'll have to take it on the 14th if you don't opt out.
Got it. Thank you.
So if you have the choice to opt out, or like if you're allowed to opt out, but you decide you want to take the exam anyway, could it hurt your grade?
I'm sorry for laughing. Yes.
Okay. I was making sure.
If you opt out, sorry. No, maybe it's not clear. But if you opt out, you get all the points for the exam by default. If you take the exam, then you get whatever grade you take on the exam. So you could potentially get a perfect score in the exam, but there's no downside risk to opting out. There's downside by taking the exam. So theoretically, if you ace the exam, it doesn't matter, but it's up to you. If you want to take the exam, I'm not going to force you to opt out. Other questions?
I was wondering when the TAs will be grading the rest of the assignments.
Yeah, we talked about that last week. We had a TA call at the end of the week, and obviously they're working from home and doing a lot of stuff too, but they committed to getting it all done by Thanksgiving. So it should all the grading updates for what you've done so far should be out this week.
Okay, thank you.
And then very little is left to be graded after this week. Okay.
So you mentioned the sorry, last question. You mentioned the extra credit that will be due this upcoming Monday, correct?
Yes.
Is that I'm trying to look in the assignments and was
I haven't
wondering.
posted it yet. It's going to
Okay.
show homework 11.
Okay, gotcha.
We'll talk about it during class today. And again, the way it works is it's another homework assignment, but technically you don't have to do it because there's 100 points in the class and it'll be 2 more points. And if you do it, it just gives you the opportunity to get 2 more points to get 100. So there'll be 102 points to get 100 as of Monday. And then 104 points as of Wednesday, etc. So these next homework assignments are technically optional, although I would recommend not doing them because they're going to be important to understanding the content and understanding your group case. So if you have any other questions, please ask. But otherwise, in the interest of time, I want to get to the content for today. So let me start out by sharing my PowerPoint file. Find my PowerPoint file. All right. So Multiples. Multiples, also called comparables or comparables. They're just a way to use market prices to value assets that are similar. So instead of a DCF, intrinsic value approach, we compare things to other things of similar that look similar and say it's worth it based on those comparisons. So in your personal life, the most common multiple you'll ever run into is if you ever buy a house, because there will be an appraisal of the house. And what the appraiser will do is they'll look at houses that have sold in the last 6 months or so near your house, and they'll take the price of the sale and they'll divide it by the square foot of the house. So they get a price per square foot. And what they're going to do is they're going to look for price per square foot for similar houses, and you're going to use it to get a price per square foot of your house. Except they're going to adjust your price per square foot based on a few factors. How many bathrooms? How old's the house? Are there any upgrades? What's your lot size? What kind of, maybe you're in a different school district. But that's the point, is that comparables are comparables so long as they actually compare exactly. And they don't compare exactly, then there has to be some nuances. But nonetheless, it does give us a useful approach for valuing, for example, private companies, because we can say if you were public and there's something similar to you that we're trading publicly, what would you be worth? They can also be used to help you understand how you're doing against your peers, and they can set up a trading range for the company. What we've been doing with our essentially bull bear sanity checks. The nice thing about multiples is they're easy. The challenge is with multiples is that we're oversimplifying everything down to really 3 numbers, right? It's growth and spread. And so therefore, differences in a few of the things that impact the multiples can actually distort the multiples across an industry. And one of the things the book talks about with distortion is capital structure. Okay? And we'll have to think about that. And non-operating items, the other one that could distort multiples that make things a little less comparable. So what are the steps to do an analysis? Actually, the most difficult step of a comparable analysis is figuring out the peer group, okay? Because you truly want things that are comparable. And so just putting 2 companies in the same industry doesn't always work, because one company might be a startup and another company might be mature. And they're actually at different stages of their life cycle and maybe less comparable than you think. So you truly want comparable companies. And we'll talk about what that means, but generally it means similar growths and spreads, ideally. Secondly, you'll then get your data from your data service. We're going to use Bloomberg. Then you'll calculate the multiples. And then using the value drivers, you'll understand why those multiples are what they are and why they're different. A few best practices as you go through this process. The most important one, choosing companies that have similar prospects for growth and return. Because multiples are basically a representation of future growth and spread, then we need to understand what those future growth spreads look like. Secondly, we've been doing this all semester. We use forward-looking estimates. The book talks about using 4 forward years when they do their example of Costco, but we're only using second forward year. But the idea is that forward-looking multiples are more normalized. Third, you want to use enterprise value multiples rather than PE because they're less subject to distortion. The book talks about using EBITDA or EBITDA. For simplicity, we're going to stick with EBIT as opposed to EBITDA to mitigate problems for capital structure and non-operating items. And then fourth, we got to adjust for those non-operating items when they exist. Simplistically, you have 2 companies that are the same. One company has a bunch of excess cash, the other company doesn't. The company with the excess cash is going to have a different multiple than the one who does not have the excess cash, even though the underlying operations could be identical. So we have to adjust for that. One of the reasons why Bloomberg does an enterprise value calculation of debt minus cash is to try and account for that. But regardless, we do have to recognize that sometimes there could be some accounting adjustments that could distort the multiples, and we have to be aware of that. Multiples can also be used for precedent transactions, basically M&A. So if I want to go acquire a company, I can use multiples in the same way that I would for valuing a private company. The only danger with precedent transactions is they might sometimes include synergies where the 2 companies are merging together and get a benefit by merging together they otherwise wouldn't have independently. And so that could distort the precedent transaction, but regardless, they are used for multiples to help us value precedent transactions as well. And the problem, though, is that when you do deal with multiples for M&A, lack of information availability. You don't really have a lot of data in many cases on those acquisitions and what was really the intrinsic value that was being paid, much less some of the numbers. And because the acquisitions could be unique, finding true comparables is also very difficult. And the timing could matter as well. So for example, if I did an acquisition today versus an acquisition pre-COVID, that was a different market environment, which could change the way that I even view the acquisition. And so essentially, you got to be careful with any type of multiple to see how truly comparable things are. Okay. All right. For this semester, we're going to worry about 4 multiples. We've already been talking about them. PE and the 3 enterprise value multiples, EV to sales, EV to EBITDA, EV to EBIT. Talking about it mathematically. If we took the key value drivers equation, which is just a reminder, this equation that we've been using all semester, and we ran these 4 numbers through the key value driver equation, we get this table of results. Okay. So given 100 of NOPLAT, 10% cost of capital, at these G's and these ROICs, these would be the results. Okay. So essentially, think of it this way. At a 10% ROIC and a 10% WACC, I basically get $1,000 worth of value, given 100 NOPLAT and a 10% cost of capital. And that makes sense because as my G gets higher, I have growth at 0 spread, 10% ROIC minus 10% WACC. And so therefore the value does not change regardless of my growth. If my growth is positive, but my spread is negative, then the faster that I grow, the less valuable I become down here. Okay. If my spread is positive, then the faster I grow, the more value I get. These are just the key value drivers in action. We've been talking about that throughout the semester. So essentially, this is what's behind multiples. So here's the point. If I were to take the results of this key value driver equation and divide it by EBIT, this is enterprise value, EBIT down here would be 154. So given $100 of NOPLAT, assume a 35% tax rate. I didn't adjust the slide when tax rate changed, but take basically 100 divided by 0.65, I get 154 of EBIT. So if I take this value divided by 154, then I get this multiple of EBIT. Okay. So said a different way, in this industry, growth at a 0 spread is a multiple of 6.5 times EBIT. Okay. And that's the way to start to think about multiples. So here's the point. If I'm looking at a company and they're supposed to be comparable, therefore the ROI or the spreads, the cost of capitals shouldn't be all that different, then growth and ROIC should be the primary drivers of the multiples. So if I'm looking at a company that's trading at, I'll make up a number here, 6 times EBIT, well, where are my 6s? Here's a 6, and somewhere in here's a 6. I know that somewhere along that range of growth and ROICs, that's where I'm going to get 6 times EV to EBIT. If I see another company that's trading at 7 times EV to EBIT, I'm going to get a range of growth and ROICs somewhere in this area. So again, I can have several numbers that sort of answer the question, but here's the point. If a company in this industry is trading at 6 times EBIT, I know they probably have a negative spread and their growth rate's probably 1 to 3%. I know that if the industry has a positive spread, they trade at 7 times EBIT, then they probably have a positive spread. And again, their growth rates are probably in the 2 to 3% range. So I don't know exactly what the numbers are by looking at their multiple, but I get a sense about where they stand on spread, for example, than the average in the industry, because a multiple is just a representation of growth and spread. Okay. And that's the idea to start thinking about the analysis for a multiple. Okay? And so there's two ways to do this comparable analysis. One is I can compare companies and multiples, kind of what we're doing here. Or two, I can look at the key value drivers to get to these companies and multiples and then understand the differences in those drivers, which is part of our homework assignment that's coming up. So continuing on, I can do the same thing with a price to earnings multiple. So what I do is I take, instead of the key value driver equation based on ROIC, I switch everything out to be net income, equity cash flows. So no plat becomes net income. Growth is growth in net income. ROIC becomes ROE, and I discount by a cost of equity instead of a WACC. So I just basically use the same formula with equity cash flows and an equity discount rate to basically get to an equity cash value to shareholders. So similar idea. So if I start with $100 in net income, 10% cost of equity, given these ROEs and these growth rates, this is the result of the key value driver equation. Just plugging in the numbers gets me those results. If I divide these numbers by that net income, so for example, 1,000 divided by 100 tells me that this trades at 10 times PE at a 10% ROE with zero spread. 10% ROE minus 10% cost of equity is zero spread. At any growth rate, I'd trade at 10 times earnings. So again, anything less than 10 suggests a negative spread. Anything more than 10 suggests a positive spread. And so again, if the company was trading, for example, at a PE of 8, then I knew that somewhere in this range would be my PEs of 8. I knew if the company was trading at a PE of 11, this would be my 11s, somewhere in this range. Okay. And so that's the point. This is multiple analysis. I don't know exactly what the growth return combination is, but I have a general sense of what the ranges are as I start to compare across companies, right? And it's all based on key value drivers when we do the math. Right? Now, ultimately, we prefer enterprise value multiples versus PE multiples for the primary reason that PE is distorted by net income. And so therefore it's distorted by accounting and capital structure. So enterprise value multiples are less distortable. I'm not saying they can't be distorted, but less distortable by cap structure and accounting differences. And so therefore they are preferred. Okay, but we'll still do a PE ratio analysis as well. And then finally, this is the formula for enterprise value to EBIT. It's just rearranging the key value driver formula to get to the enterprise value to EBIT formula. We've been using this for the last month in our valuation model. But basically, if we take key value drivers, no plat is EBIT times 1 minus the tax rate. Divide both sides by EBIT, get enterprise value to EBIT, and then you get this formula over here. Now, again, the book talks about using EBITDA, enterprise earnings before interest, tax, and amortization. For simplicity, we're sticking with enterprise value to EBIT this semester, but you can read the chapter on EBITDA about why that might be more preferred. In addition, we'll do enterprise value to sales. And this is the derivation to get to enterprise value to sales. So again, if we start with our key value driver formula and we get to no plat is revenue times margin, divide both sides by sales. So enterprise value to revenue is revenue cancels out. It's basically margin times 1 minus the tax rate times 1 minus the growth of ROIC over WACC minus G. This is that formula from the previous page down here. So enterprise value to sales is margin, which is your EBIT margin times enterprise value to EBIT. That's the formula we've been using as well to get our long-term margin, because we've been dividing that by enterprise value to EBIT. And that's your formula for estimating your long-term margin, which is, again, just a derivation of key value drivers. So what you can see is that the key value driver formula is really behind all 4 of the multiples that we've been talking about this semester. It's just rearrange math, right? And so this becomes key to understanding what drives multiples. It's a function of the key value drivers, which is a function of growth and spread. Multiples are just a representation of growth and spread. Okay. So how does this translate into analysis? So what I want to do next is I want to open up the spreadsheet that I gave you. Called, it's in the file section under multiples, called multiples assignment template. Okay. And there's two tabs. There's a PE tab and there's an EV to EBIT tab. The yellow cells are the ones we're going to fill data in. And for simplicity, I've actually put the key value driver formula in here for you already to create this formula. Okay. And then we're going to get our data from Bloomberg. Okay. Just reading a story about 62 million people watched the Queen's Gambit in the last month. How chess has become exciting recently. Actually, I watched the show. It's pretty good. But back to our analysis here. So we're going to do this on 3 companies. And we're going to start out with Costco. So we're going to look at a multiples analysis. Company A is Costco. Company B is Walmart. And company C is Target. This is the one we're going to do in class as an example. So I'm going to save this as section 401. So essentially, we'll start out with understanding the PE multiples for Costco, Walmart, and Target. So basically what I'm going to do is I'm going to go for Costco. I'm going to go first to EEO. And I'm going to use the second forward year. Talked about using forward multiples, same as we've been doing for the last month or so. And I'm going to get the data here to do the analysis. Okay. Now, just to be consistent with the 11 a.m. section, I'm going to use the data from the 11 a.m. section that I've already taken screenshots for. So in the 11 a.m. section, the enterprise the price to earnings multiple in the second forward year is 21.24. Okay. So just so we all have the same answer today, second forward year, actual PE, 21.24. Okay. But that's just the screenshot. If I did it right now, sorry, that's Target. I want Costco. Too many files open. Costco EO. Sorry, it's 35.5. Sorry, I typed the wrong one in. Actually, it'd be 35.62. Again, based on time of day, these multiples change. So just so we're just being consistent with the earlier class, I took a screenshot at that time. So that would be the 35.5. Okay. Now, next, I need to get the expected return on equity for the company. So this is what the return on equity is going to be into the future. If I actually minimize the EEO screen, there's actually a scrollable list. Down here is the forecast for return on equity that the analysts have for the next 4 years. Okay. So I want to use this as representative. Now, if this is not representative, if I'm in like a V or something like that, then I need a representative perpetuity return on equity. But this looks pretty stable, so I'm going to assume that the average of these 4 years is pretty representative of the future. So for return on equity for Costco equals, round off, 22%, so 0.22 plus 21.4.21 plus 21 plus 23. 0.21 plus 0.23 divided by 4. It's about 21.75%. All right. The net income in the second forward year, 1.2. Net income adjusted, 47.43. And then finally, I'll go to the WACC. And I need a cost of equity. Cost of equity for Costco right now is 6.4%. And just to verify, Costco WAC, took the screenshot earlier, 6.4 this morning. So that didn't change. All right, so this is a similar exercise that you've been through before. So essentially we're solving for a G that makes these two numbers equal. So what is the growth in net income expected to be? Well, put in 3%, probably higher than that, 4.2. It's gonna be somewhere around 4.1. One, two, middle, close enough. All right, I'm gonna do the same process for Walmart. So again, for Walmart, if I go back to Bloomberg, WMT, US equity, cost of equity for Walmart right now is 5.2. It was 5.2 this morning. Okay. Taking EEO for Walmart, the other screen I'm going to get. So this was the PE for Walmart right now, 26.2, but I'm going to put in the one this morning. This is the net income, 16,134. So I'll go ahead and put this in. This is the expected return on equity for the next 4 years. So 21, 19, 20, and 18 equals 21 plus 19 plus 20 and 18. And again, I believe that that's representative, so I don't have to change that. And again, I'm taking the screenshot from this morning as opposed to using the current PE just to be consistent with the earlier class. On that screenshot there, PE was 26.12 in the second forward year. So again, this G is going to probably be lower, 2%, 2.1%. Nine, 1.8. It's not 1.71, maybe somewhere in that range. And then Target, we do the same process. So again, Target US equity. Right now, second forward year, net income, 4140. Expected return on equity for the 4 years looks representative. So 33. Becomes 29 and then 30. I'm just rounding off. And then 27.
So you put 0.39 instead of 0.29.
Sorry, it's 0.29. Thank you. Divided by 4. And again, what I really want, I mean, you can say, well, why is he rounding off? I want something that's representative of the long term. So for example, if these numbers were like, just making it up, but like, it's like 5, 5, 29, 29, I wouldn't probably average the 4 and I'd say, oh, well, 29 is probably more representative post-recession. Hint, that's something you're gonna have to do with CVS. Anyways, this seems representative, pretty stable industry. So final piece is I need my WACs. So I get my cost of equity. Again, I took a screenshot. It was 6.4% for Target this morning. It was also 6.4%, didn't change. So I'll use the 6.4 just to be consistent. And so again, what is my observed PE? Well, this morning for Target, so I'm just going to type in my mistake. It was 21.24. I did the screenshot earlier. And again, I want to do these around the same time because I'm trying to compare them. That's why I'm also using this morning's stock prices. So what is my growth? Again, it's going to probably be somewhere around 2% as well. Okay. And then just save this so I don't accidentally delete it. But now I'm ready to do my analysis. And my analysis is relatively straightforward. So these three things explain that number. So why are these numbers different? And so the language that we'll use are premium and discount. If the multiple is higher than its peer, it's called a premium. If the multiple is lower than a peer, it's called trading at a discount. So why is Costco trading at a premium to Walmart? Why is Walmart trading at a discount to Costco? Basically the same thing. Well, here's what I know. It's growth and spread. Start out with a spread. So Costco's spread is higher than Walmart's. 22 minus 6 is about 16. 20 minus 5 is about 15. Okay. So they have about a 16-point spread at Costco. They got about a 15-point spread at Walmart. In addition, Costco's growth is higher. It's about 2.5 points higher, 4% versus 1.7%. So it's the combination of the 2 points more per year in growth at slightly higher spread, the extra 1% in spread. That is the primary reason why Costco is trading at a premium to Walmart. We're saying the same thing. Walmart's trading at a discount to Costco. But the other thing that's impacting this is the cost of capital. Because even though these spreads are similar, Walmart's WACC is lower than Costco's. That means that Walmart is mitigating the difference between these two by having a lower WACC. Show you the example. If Costco had the same WACC as Walmart, their PE would be 75. So the PE difference is tempered by the fact that Walmart is perceived to be less risky. Said a different way, if Walmart had the same risk as Costco, their PE would be 19. So really, it's growth and spread are helping Costco, but it is being mitigated by the higher level of risk compared to Walmart. What is the difference between Costco and Target? Why is Costco trading at a premium to Target? Costco is trading at a premium to Target because for the same risk, Target has a higher spread. 30 minus 6 is 14. Sorry, 24. 22 minus 6 is 16. So there's a higher spread over here at Target. But even though it's a higher spread, 2% less growth per year. And so that extra 2 points of a higher spread of growth is the primary reason why Costco is trading at a premium. That is what you'd have to write up in your paper. That is what you have to explain. Questions? All right, if no questions, then we'll move on to the enterprise value tab. So now we're going to do the enterprise value multiples for Costco, Walmart, and Target. Okay, so again, enterprise value to sales, enterprise value to EBIT. We got those in Bloomberg, back to Costco, off of the EEO screen, just as we've been doing early in the semester. We're using second forward year. There's enterprise value to sales. There's enterprise value to EBIT. Okay. But again, just to be consistent, I'm going to use for Costco those multiples during the 11 a.m. section this morning. So enterprise value to sales for Costco was 0.86, and the enterprise value to EBIT was 25. 6, 25. And then, in fact, I'm just going to go ahead and do this for Walmart and Target. Here's the Target ones. I had it open. This was this morning. EEO for Target. Enterprise value to sales, 1.09. Enterprise value to EBIT second forward year, 16.95. And then finally for Walmart, this morning. Second forward year, enterprise value to sales, 0.87. Enterprise value to EBIT, 20.19. Now you'll notice up here that the operating margin is being calculated because in our formula, we said that margin is EV to sales divided by EV to EBIT. You've actually been doing that this semester. So the spreadsheet's automatically calculating. Now we don't have a tax rate, so we don't have an after-tax margin. But we're going to get a tax rate in just a minute. Then I need my WACC for the three companies. All right. Again, this morning, Walmart's WACC was 4.5. This is WACC as opposed to cost of equity. So this would be 4.5. Costco's WACC this morning was 6. And Target's WACC this morning was 5.5. So 6 and 5.5. Okay. Now we're going to solve for G, which is what we've been doing in our models. So we need a tax rate, a representative tax rate going forward, and we need a representative ROIC going forward. Okay. So this is a similar process for tax rate that we had done earlier this semester. So basically we would go to either BRC or EVT. We've been finding them more readily available in BRC. And so for example, JP Morgan's usually pretty good about giving a model. This is the one I looked up earlier for Costco, search for tax rate. And in the out years, the tax rate that JP Morgan's using is 26%. So I'm going to use 26% for my tax rate going forward. Okay. In the interest of time, I did this in an earlier class. So the tax rate for Walmart and Target were 26.8 and 22. Basically, you know how to look those up. Look them up in BRC, find an analyst report, and get the tax rates. The hard part is this one, expected ROIC. This is the ROIC into perpetuity. And so the problem is Bloomberg in their EEO does not calculate ROIC. So we need representative ROICs for the future. Now, as a clue, these ROEs are pretty stable, which suggests to me that the ROICs are probably going to be pretty stable too. Okay. So here's the point. If I go to RV and I go to my peer list, I can do an operating ROIC and basically get a current operating ROIC for each of these companies. Now, I need something that's representative of the future. And since these ROEs seem pretty stable, I can make an assumption that these ROICs are probably pretty stable too. That somewhere around these numbers are probably their expected ROICs in the future as well. Nothing substantially is changing about these businesses. Now, if this were the case where the businesses were really struggling right now, think about when we did Delta Airlines, and the next couple of years are not represented their long-term ROIC, I would need to come up with an operating ROIC that I thought was representative in perpetuity. Okay, but this seems to be reasonable to me for these companies. If I didn't have an ROIC that was operating, I could use a Bloomberg ROIC as a proxy. But the idea is I need a perpetuity ROIC, just like I had a perpetuity ROE. And so in this case, I'm going to use these numbers because I think they're representative of perpetuity. So again, Costco, 22.51%. Walmart, where's Walmart? 10.27%. And what are we at? Target is 13.5. So what growth solves to make these EV to EBITs basically the same? Sorry, so something pop up in the chat. So they basically said, how do you find an expected ROIC for a company that doesn't have that has an unstable ROE, for example? And so whether it's an unstable ROE or just, as I said, not representative, you have to come up with a representative one. So similar to in your last assignment, you had to come up with representative WACs. You have to come up with representative ROICs. Okay. And we'll talk more about that next week. But the short answer is that's what you have to do. You're going to have to create essentially a synthetic ROIC that is representative of the long term if the ones in the next couple of years are not representative of the long term, because we're dealing with perpetuities here, and this is the perpetuity one. A second way to do this, by the way, could be to do a full valuation of the company. Now, it gets more cumbersome to your assignment than this method, but if you do the as-is valuations for these companies, you're going to calculate an ROIC in a perpetuity. And that one could also be representative. But I'm trying to give you a simpler way to do it without having to do the full valuation. Okay. So now we just need to solve for the G's. So what are my G's? So for Costco, again, it's probably going to be around 3, 4. Actually, it's like 3.5. 3.5, right, isn't it? Walmart is probably going to be more like 1, 2, 1.2, 1.3, 4, 4, 1.35 probably. And for Target, it's probably gonna be a little higher, 2, nope, 6, 4 as well. So 1.37. Close enough. All right, so now I'm ready to do my analysis. So what is my analysis? So my analysis is basically going to be, hold on one second. All right, so I want to explain, and in this tab, it's really two multiples, what's going on with EV to EBIT and what's going on with EV to sales. So again, Costco compared to Walmart and Target, premium or discount. Start out with Costco against Walmart. Costco is trading at a premium, EV to EBIT to Walmart. Said another way, Walmart's trading at a discount, EV to EBIT relative to Costco. Why? Well, now I have 4 drivers instead of 3 drivers, okay? So first thing I can see is growth and spread. So let's look at spread. Tax rates are pretty similar, so I don't think it's the tax rate. So spread, this is about 16 points. This is about 6 points. So Costco has about 10 more points of spread than Walmart. That's one of the reasons why they're trading at a premium. And same thing, Costco has a higher growth, same as PE, of about 2.2% more growth per year than Walmart. When I compound the higher growth and the higher spread, that's why they're trading at a premium for a similar tax rate. However, similar thing, Walmart's lower cost of capital offsets some of that advantage, because same thing, if Walmart had a 6% WACC, their EV to EBIT would be 14. Said a different way, if Costco had a 4.5% WACC, their EV to EBIT would be almost 63. So essentially, Walmart is mitigating some of the reason why they're at a discount because of the lower risk, but primarily Costco's trading at a premium because of the 2 points higher growth and 16 points versus 6 point higher spread. Okay, offset by the 1.5 points more of higher WACC. Target is trading at a discount to Costco. Costco is trading at a premium to Target and EV to EBIT because, again, same idea. Target has a lower spread than Costco at a lower growth rate, 1.3 versus 3.5. 13.5 minus 5 is about 8 versus 16. But Target's WACC is closer to Costco's. So the point is, the reason why Target's trading at a discount to Walmart, it's all WACC. Right? You can see that clearly here. In terms of Costco, the reason why they're trading at a discount to Costco is lower growth, lower spread, despite the fact that they have a lower cost of capital and are paying a slightly lower tax rate. So Target's got two things favoring them, which are making the discount not as much, but they are trading at a discount to Costco because Costco has the 2 points higher growth and it's got the higher spread. So that's what's going on with EV to EBIT. What's going on with enterprise to sales? Why am I paying more for Walmart's EV to sales than Costco's EV to sales? Well, what's primarily driving EV to sales, going to go back to my PowerPoint here. EV to sales is heavily influenced by margin, and then all the enterprise value EBITs. So here's the point. Walmart has a higher operating margin, 4.3 versus 3.4%. And so that's why it's trading at a premium. But it's also influenced by the key value drivers equation, EV to EBIT. The problem here is ROIC is lower at Walmart. So if I know my ROIC and I know my margin, I can back into productivity. Because remember, margin times productivity is ROIC. So since I know my ROIC and I know my margin, pre-tax margin, after-tax margin, the multiples give me a hint of what they think the productivity has to be. So this times this, 1 over this is that. So I'm solving for this automatically. You can see the equation here. So here's the point. Walmart, which has a higher margin, spending 31 cents of capital per dollar of sales. Costco, which has a lower margin by 1 point, 3.4%, is only spending 11 cents of capital per dollar of sales. So Costco is benefiting by the improved productivity and better ROIC because of that to basically trade at a similar EV to sales to Walmart. Target is trading at a premium EV to sales to Costco and Walmart because they have the highest margin in the industry at 6.4%. But again, mitigated by the fact that the productivity is 0.37. So again, same idea. Target is benefited by having its higher margin. I pay more for sales because it has a higher margin, but the lower productivity, the more capital with the slightly lower ROIC offset some of their advantage. And that's why they're trading at a premium, but not as much of a premium as they could if they had a similar level of productivity to Costco. So that's why Costco and Walmart are trading at a similar EV to sales. Costco's trading at a premium, Costco being a discount to Target, and Costco's trading at a premium EV to EBIT to Walmart and Target. That's also what you have to write up and explain in your paper. Questions? I know there's a lot very fast.
Could you revisit the productivity metric and how that plays into EV to sales again? Sorry.
Okay. So productivity is invested capital to sales. In every one of our valuation models, when we were doing the key value drivers equation, open up a model real quick. Where do we fall? Homework 10. Like when we did delta as an example in our as is for delta, this ROIC drivers, that's this invested capital sales. We said this and this give you that. So that's what we're doing here. In this spreadsheet, I'm basically saying we know the ROIC, we know the after-tax operating margin, that tells what my tax rate is that. We can solve for this. Just solving for the productivity. Because this times 1 over this is that. So here's the point. What drives EV to sales? It's a function of 2 things. Our margin and the enterprise value to EBIT equation, which is that equation. So back to this, ROIC. So it's margin and ROIC. That's really what's going to matter here to EV to sales. And so margin and ROIC drive this one. Okay. And so essentially, here's the point. Generally, margin should have the biggest impact, but it doesn't. This extra margin, I'm still paying because the whole is $1 of sales gives me 87 cents of value here. $1 of sales gives me 86 cents of value here. Why am I getting the same amount of value when I sell something? It's how much margin I make when I sell something. But the problem is Walmart has to put more back, more investment to get that sales. So therefore, the free cash flow per dollar of sales, the enterprise value per dollar of sales is actually tempered because they got to put in 3 times as much capital as Costco does to generate those sales. So even though they got a higher margin, it's being offset by the productivity. Translate, they need more gross investments, even though they have more gross cash flow. And that means they end up with a similar value per dollar of sales. Target gets more free cash flow value per dollar of sales because despite the fact that they have more gross investment, they have an extraordinarily high margin compared to their competitors. Gross cash flow, proxy for gross investment, free cash flow. That's why they're trading at a premium. Other questions? All right. So your homework assignments. I haven't put it up. I'm going to put it up shortly. Is basically to do an analysis and write-up, which we call it homework 11. It's due Monday, on Lockheed Martin, Northrop Grumman, General Dynamics. So we're going to do defense and aerospace. Those are your 3 companies, right? I'm going to try and end class early right now to give you time, if you want, to get the data and to start the assignment right now, right? And this video should be done in about 10 minutes. And I will be posting that up on YouTube as well if you need some additional work. But if at least you want to use the rest of the class time to start using Bloomberg to get your data, to get a head start, for those of you that want to do this, it's LMT, Lockheed Martin, Northrop Grumman, NOC, and General Dynamics, GD, are the 3 companies. Okay. And again, I'll post the homework assignment shortly. Okay. I'm going to give you as much time as I can for the balance of class today to work on that. Have a happy and safe Thanksgiving. Don't do anything too crazy. Hopefully everybody stays well, and I'll see you next Monday when we're back in class and we'll discuss this assignment and give one more. Okay. Other than that, we're going to end class a couple minutes early so you can work on this. Have a good break.